You know, usually when you get a medical diagnosis, you sort of expect this certain level of engineering precision.
Right, like a clear answer.
Exactly. Like if you break your arm, you go to the hospital, they put you in an X-ray machine, and it prints out this stark black and white image. There's a jagged white line across the bone. The doctor points at it and says, there's the problem.
It's totally binary. The bone is broken or it
Yeah.
isn't. The treatment plan is obvious from that point on.
Yeah, but the moment you step out of the hospital and look at, say, macroeconomics and global geopolitics, that X-ray machine is just completely shattered. We are currently looking at a diagnostic landscape that is incredibly murky.
Oh, absolutely. Muddy waters don't even begin to cover it.
I mean, I want you, the listener, to just think about your own neighborhood for a second. Think about the price of your groceries, your mortgage rate, your job security. Now imagine all of that is sitting on top of this massive powder keg of global economic fragility.
Stretched stock valuations.
Yeah.
Massive national debt.
Shifting demographics, all of it. And while we're all sitting on this mountain of explosives, someone thousands of miles away just lit a match in the Middle East. It's this wildly complex, interconnected web playing out in real time. And our mission today for this deep dive is to try and, read that murky X-ray.
Which is an incredibly ambitious goal, considering, like we said, we are dealing with the absolute definition of diagnostic muddy waters right now.
So what exactly are we analyzing today? We're pulling from a highly urgent, really dense transcript from Mario Nawfal's YouTube channel.
Mm-hmm.
It features this long-form conversation with a former Wall Street analyst, Edward Dowd. Now, I want to be really clear right off the bat here. This material covers some incredibly intense, politically charged ground.
Yeah, it definitely does.
They get into the U.S. administration, former President Trump, border policies, the actions of the Chinese Communist Party. But leaving the political debates over those specific topics completely aside, our goal here is to impartially analyze the underlying math.
Right. And I think that's a crucial ground rule to establish for you listening. The numbers themselves are dramatic enough without adding any political spin. We are going to focus strictly on the economic arguments, the supply chains, and the financial mechanics they present. We're looking at the numbers, not endorsing the politics.
Exactly.
Because the thesis presented in this conversation connects some seemingly completely disparate dots.
Yeah.
I mean, we're going from energy infrastructure in the Persian Gulf over to the current artificial intelligence stock bubble to an impending domestic housing crisis.
All the way to a demographic collapse currently unfolding in China.
Yeah, all connected.
Okay, let's unpack this. Let's start with the spark that sets this entire chain reaction in motion. The conversation lays out a situation of acute, immediate crisis in the Middle East.
Right.
They detail this complete breakdown in diplomatic negotiations, which has basically escalated from posturing into physical, targeted strikes on vital civilian and economic infrastructure. We're talking about Iranian desalination plants and power plants actually being hit.
Which is a huge escalation. We really need to pause and unpack the gravity of that specific detail.
Yeah, the desalination plants.
Because targeting desalination plants fundamentally alters the rules of engagement there. I mean, desalination isn't just an economic asset. It is the absolute prerequisite for human survival in that region.
Right, it's the infrastructure required to literally provide drinking water in a desert.
Exactly. When you attack the water supply, you are essentially telling your adversary that there are no longer any boundaries at all.
And the retaliation threat that the source mentions is, it's equally catastrophic, but on a global economic scale. Iran has reportedly issued unprecedented threats to destroy entire regional infrastructures. They specifically drew a red line, threatening to target the massive international airports in Dubai and Abu Dhabi, and also 2 major ports in the United Arab Emirates if their domestic bridges are attacked again.
And we have to remember, Dubai isn't just a tourist destination. Far from it. The airports in Dubai and Abu Dhabi, along with those UAE ports, they act as the central nervous system of global logistics and trade. They are the primary crossroads connecting Asia, Africa, and Europe.
So we're talking about millions of tons of cargo.
Millions of tons, critical supply chain components, an enormous percentage of global air freight. It all moves through those specific hubs. If you take those offline, you aren't just disrupting local travel. You are physically severing a primary artery of the global economy.
And the economic translation of that terror, that's what we really need to dig into. The modeling discussed in the material suggests a scenario where, if these energy and logistical choke points in the Gulf are closed or even severely compromised, the price of oil could potentially skyrocket.
And the number they throw out is staggering.
Yeah, to $250 a barrel. $250. To help visualize this, I used to think of oil prices as the global economy's check engine light.
That's a common way to look at it, sure.
But reading this, that's not quite right. A check engine light means you can still, slowly drive the car to the mechanic. If oil hits $250 a barrel, it's more like all the oil has suddenly drained out of the transmission while you're on the highway. You can push the gas pedal all you want, but the gears are just violently grinding against each other until they shear off entirely. The vehicle cannot move forward.
That transmission metaphor is much, much closer to the reality of the situation. Oil is the literal lifeblood of the physical economy. It's not just about what you pay at the pump to commute to work.
Right, there's everything.
It's the diesel in the freight trains. It's the bunker fuel for the massive cargo ships crossing the Pacific. It's the baseline raw material for agricultural fertilizers, for plastics, pharmaceuticals, asphalt.
So it's baked into the price of literally everything we touch.
Exactly. When you take the baseline input cost for almost every physical good on planet Earth and you suddenly multiply it by 2.5 or 3, you trigger a macroeconomic phenomenon known as demand destruction.
Demand destruction. Okay, let's really get into the weeds on the mechanics of that. How exactly does demand destruction play out in the real world?
Well, the conversation notes that we actually just saw a tiny preview of this.
Oh, right, back in May.
Yeah, there was a minor oil price spike in May. Just a blip, really, compared to this apocalyptic $250 scenario. And the result was that consumer credit card debt actually dipped negative for the first month in a long time.
Wait, credit card debt dipped negative. That means people actually paid off more than they spent. That sounds like a good thing, doesn't it?
On an individual level, sure, paying down debt is good. But macroeconomically, that specific data point is incredibly telling and actually quite scary.
Right.
A $250 barrel of oil acts as an immediate, massive, unavoidable, and highly regressive tax on the consumer.
Ah, I see.
If it suddenly costs you double to fill your gas tank and your home heating bill doubles, you don't really have the option to just not commute to your job or let your pipes freeze in the winter. You're forced to pay that increased cost. So where does that extra money come from?
It comes out of everything else. You stop going out to restaurants. You cancel your streaming subscriptions. You delay buying that new laptop or upgrading your phone.
Exactly. You are destroying the demand for all other goods and services because the foundational cost of simply existing and moving around has completely consumed all of your discretionary income. That is demand destruction.
And the immediate front-end result of that, according to the modeling they discuss, is a massive spike in inflation. They predict that in a worst-case scenario, headline CPI, which is the Consumer Price Index, basically what we all pay for a basket of goods, could peak anywhere from 8% to 11% very rapidly.
Which is brutal.
Yeah, I mean, we all remember how painful 8% inflation felt just a couple of years ago. This would be a violent return to that.
It would be, but it's crucial to understand the actual sequence of events here. If we connect this to the bigger picture, there is a brutal irony to how this plays out macroeconomically. Well, you get this massive inflationary oil shock on the front end. Prices for everything explode because transportation and manufacturing costs explode. But that exact inflationary shock is what triggers a rapid, deeply deflationary global recession on the back end.
Okay, I want to piece this together. How does wild inflation suddenly flip into deflation? Is it basically because prices spike so violently on Monday that by Friday the consumer has literally emptied their bank account, meaning they can't buy anything on Saturday, which forces retailers into a panic?
You're hitting on the exact mechanism. It's a chain reaction of pure panic. The prices go up so fast that the consumer completely taps out. They retreat from the broader market entirely.
Right.
When they stop buying the laptops, the clothes, and the furniture, those inventories begin to pile up at warehouses and in the back rooms of retail stores.
Right.
Retailers look at their balance sheets. They realize they have massive capital tied up in unsold goods, and they panic. So they slash prices drastically just to clear the inventory. That aggressive price slashing that is the deflation.
But by the time the prices are slashed, no one has the money to buy the discounted goods anyway, right?
Yes, precisely. Because while the retailers are slashing prices, they are also missing their quarterly earnings targets. When companies miss earnings, what do?
They lay people off.
Exactly. They lay off workers to cut costs. Unemployment spikes. Now, people have even less money to spend, regardless of how cheap the goods on the clearance rack are. The global economy essentially suffocates on the price of energy.
Wow.
The analysis notes that if oil hits $250, it actually wouldn't stay there very long because it would shut down global industrial activity so fast that the demand for oil itself would collapse, bringing the price crashing back down. But by then, the economic damage is completely done.
It's like a fire burning so hot and so fast that it consumes all the oxygen in the room and just chokes itself out.
That's a great way to picture it.
And just to add another layer of anxiety to this whole powder keg, the discussion mentions a genuinely alarming detail about our buffer against this kind of shock. They talk about the U.S. Strategic Petroleum Reserve.
Right, the SPR. This is the emergency stockpile of crude oil maintained by the U.S. Department of Energy. It's physically stored in these massive, artificially created underground salt caverns along the Gulf Coast, mostly in Texas and Louisiana.
I always picture huge metal tanks, but it's actually in caves.
Yeah, giant salt caverns. And the entire purpose of the SPR, dating all the way back to the oil shocks of the 1970s, is to protect the U.S. economy from exactly this type of severe supply disruption.
Right. Well, they cite statements claiming that the Strategic Petroleum Reserve was allegedly only 4 weeks away from effectively running out of usable, deployable crude.
Hmm.
And the terrifying kicker here is that the statement was made 4 weeks prior to the recording of this conversation, meaning, according to this timeline, we're sitting right at the inflection point, basically running on fumes.
Which leaves the global market entirely dependent on the desperate hope of a quick political or diplomatic resolution, rather than having a physical, mathematical buffer of oil to actually stabilize prices.
That's a very precarious place to be.
It is, and it explains why market behavior surrounding oil right now is so erratic and volatile. You see this pattern of extreme anxiety over the weekend when military escalations tend to happen, followed by these hopeful, sigh-of-relief rallies during the week when a headline suggests negotiations might resume.
The market is trading on pure emotion and headlines rather than actual fundamentals.
Because if the market actually prices in the reality of a closed Strait of Hormuz combined with a depleted strategic reserve, the math becomes fundamentally unworkable for most businesses.
So if a $250 barrel of oil chokes off the global capital flow, where does all that pressure go? This leads us to a really crucial pivot point. What happens if an external shock of that magnitude slams into a domestic U.S. economy that looks strong on the surface? I mean, we see the stock market hitting all-time highs, but is actually structurally already hollowing out from the inside.
That is the ultimate test of economic resilience. And the argument presented forcefully in this source is that the U.S. economy is incredibly vulnerable right now.
Yeah, they call it a three-headed monster.
Exactly.
Yeah.
It is facing what they described as a three-headed domestic monster: an artificial intelligence stock bubble, a highly precarious private credit market, and a rolling housing crisis.
Let's take the first head of that monster, the technology sector. The conversation describes the current AI boom not as the dawn of some new economic utopia, but as a classic historical capitalist bubble.
Right.
They map out the anatomy of it, and honestly, it sounds really familiar. Immense, unbridled excitement for a new technology, a desperate gold rush mentality where companies fear being left behind, massive amounts of capital raised to build infrastructure, eventual overcapacity, and then inevitably a bust.
It follows the historical pattern perfectly.
And I have to push back here, just playing devil's advocate. Look at what AI can do today compared to even a year ago. It's passing medical exams, it's writing code, it's generating entire videos from a simple text prompt. Isn't this fundamentally changing human productivity? Why is this just a bubble and not the legitimate foundation of a new normal?
It's a really fair pushback, but it's important to separate the technological reality from the financial structure built on top of it.
Okay, separate the tech from the money.
Right, because it can actually be both.
Yeah.
The technology can be world-changing in the long run, while the financial structures funding it in the short run can still form a massive destructive bubble.
Yeah.
I mean, think back to the dot-com boom of the late 90s.
Yeah, the internet definitely changed the world.
Exactly. It completely revolutionized commerce, communication, media.
Mm.
But in 1999, companies like Pets.com were still massive financial bubbles that wiped out billions of dollars in investor wealth when they popped. The utility of the internet didn't save those specific companies from having terrible financial mechanics.
That makes sense.
And the analysis uses a golden rule to understand this dynamic. Credit always ends the party.
Credit ends the party, meaning it's not necessarily that the AI models fail to get smarter, it's that the funding required to build the massive server farms to train them eventually just dries up.
Precisely. And this points us toward a hidden fragility in how this specific AI boom is being financed. They point a spotlight squarely at the private credit market.
Let's break that down, because private credit isn't really something most people interact with on a daily basis. Like, if I want to buy a house or start a small business, I go to a traditional bank.
Right, and traditional banks are heavily regulated. They have strict reserve requirements, they undergo stress tests, and their balance sheets are highly scrutinized by regulators. Private credit is an entirely different beast.
How so?
Well, this market has ballooned into a massive $2.5 to $3 trillion industry. These are private investment funds, often managed by large asset management firms, that lend money directly to companies. They operate with far less transparency and entirely different regulatory oversight than traditional banks.
And the conversation cites Morgan Stanley data noting that out of the roughly $1.5 trillion currently flowing into what they call hyperscaling tech finance, which is the money used to build the colossal data centers, buy the specialized GPUs, and power the massive energy grids required for AI, potentially half of that funding might be coming from the private credit market.
Half. That's a staggering amount of unregulated leverage.
But why is that inherently dangerous? If private credit funds want to take the risk of lending billions to AI startups, isn't that just free market capitalism functioning as intended? Let them take the risk.
It functions beautifully when interest rates are low and everyone is highly optimistic. It becomes incredibly dangerous when the music stops. The material notes that this private credit market is currently beginning to experience significant stress. They specifically mention terms like gating and withdrawals.
I want to focus on that word, gating. That sounds like a financial roach motel money checks in, but it can't check out.
That is a very accurate, albeit grim, way to describe the risk of illiquidity. Let's compare it to the public stock market. If you own shares of, say, Apple, and you get nervous about the economy on a Tuesday morning, you can click a button, sell your stock on the public exchange, and have your cash sitting in your account by Thursday. The public market is highly liquid.
Right.
Private credit is illiquid. If institutional investors, like huge pension funds or university endowments, get spooked about the viability of these AI investments and want to pull their money out of a private credit fund, the fund manager doesn't just sell the assets. They can't.
So what do?
They legally drop a gate. They freeze the withdrawals.
Because the fund doesn't actually have billions of dollars in cash just sitting in a vault somewhere. That money is physically tied up in concrete, copper wire, and silicon chips in a server farm somewhere in Virginia, being built for an AI startup that might not even turn a profit for 5 years.
Exactly. The capital is locked into physical, highly illiquid infrastructure. And the analysis notes that corporate bankruptcies are starting to tick up in the broader real economy. Eventually, that stress catches up to these private credit markets. And because of this freezing effect in private credit, the public equity markets, the stock market that everyone watches on the news, is starting to get the message.
And this brings us to a term they use that I want to define really clearly for the listener: the momentum factor.
Ah, yes.
They note that the momentum factor, which has been heavily driven by this AI bubble, recently experienced its worst month ever, immediately following a month where it was the absolute best performing strategy.
For those of us who don't spend our days building quantitative trading algorithms, what exactly is the momentum factor?
Sure. So in quantitative finance, the momentum factor is essentially an investment strategy based on the idea that objects in motion tend to stay in motion.
Like physics, right? It's the strategy of buying stocks that have had high returns over the past 3 to 12 months and selling those that have had poor returns. It assumes that whatever the trend is, it will persist. And over the last year, the momentum factor has almost entirely been a proxy for the AI trade. Algorithms and human traders just kept piling into the handful of massive tech companies building AI purely because those were the stocks going up.
It's the ultimate FOMO, fear of missing out trade, but automated by supercomputers.
Exactly. But when the momentum factor experiences its worst month ever right after its best month ever, that violent whiplash is a massive red flag.
Because things in motion suddenly reverse.
Right. It's classic bubble-bursting behavior. It indicates that the smart money in the credit markets is starting to ask hard questions about profitability, funding is beginning to dry up, and those automated momentum algorithms are abruptly reversing course.
Okay, so the AI darling of the stock market is wobbling because its private credit foundation is starting to show structural cracks. Let's shift our focus to the second domestic threat, which is far less abstract and hits much closer to home for the average person: the real estate market.
The housing cycle.
Yeah. The argument presented here is that the current housing market, with its sky-high valuations that we all see, has been artificially pumped up by two distinct, massive macroeconomic forces over the last few years.
And the first force is monetary policy, specifically the actions of the Federal Reserve. During the economic crisis surrounding the pandemic, the Fed bought between $1.5 and $2 trillion in mortgage-backed securities.
Let's trace how that actually impacts a family trying to buy a house today. A mortgage-backed security is basically a bundle of individual home loans, right?
Yes. When a local bank issues you a mortgage, they usually don't keep that loan on their books for 30 years. They sell it to an aggregator who bundles it with thousands of other mortgages into a security, and then they sell that security to investors.
Wow.
By stepping in and buying $2 trillion worth of these securities, the Federal Reserve essentially became the ultimate unlimited buyer.
They just hoovered them all up.
They did. They took all that risk off the bank's balance sheets. And this artificially suppressed mortgage rates down to historical lows. I mean, remember the 2.5% or 3% mortgage rates everyone was getting a few years ago?
Right, which allowed banks to issue an absolute flood of new, incredibly cheap mortgages, which hyper-stimulated the demand for housing. Everyone wanted to buy because the borrowing cost was essentially free money in real terms.
Exactly. That was the monetary force. The second force they point to is demographic. The conversation argues that a wave of roughly 20 million immigrants entered the country over a very compressed period, about 2.5 to 3 years.
And here again, we need to maintain our analytical focus for the listener. The material attributes this influx to specific border policies and the political environment. We are entirely bypassing the political debate surrounding immigration policy here.
Completely.
What we are analyzing is strictly the mathematical supply and demand reality of adding that many humans to an economic system in such a short time frame.
And the math is very straightforward. Regardless of how or why 20 million people arrive, they all require physical shelter immediately. That creates a massive sudden surge in housing demand. It spiked home prices, and more importantly, it triggered an enormous wave of commercial construction.
The apartment boom.
Yes. Developers rushed to build massive multifamily housing projects, large apartment complexes, to try and absorb this sudden population surge and capture those lucrative rental yields.
But the analysis argues that we're now arriving at this critical, really painful turning point where both of those forces, the cheap money and the surging demand, are aggressively reversing. They claim that the population influx has essentially leveled off, and they even point to a phenomenon of self-deportation beginning to occur as economic conditions tighten up.
And this is where the macroeconomic detective work becomes really fascinating. How do you prove that a housing market as massive as the United States is fundamentally turning? You don't just look at Zillow estimates.
Right, those could be lagging.
You look at a very specific real-time metric, new tenant rents.
Let's explain why that metric is the key to the whole puzzle. Because if I've lived in my apartment for 5 years, my rent is probably somewhat sticky, right? The landlord might raise it 3% or 4% a year, but they generally want to keep me there to avoid the cost of turning over the unit, repainting, all that.
Right. Your current rent doesn't reflect the exact up-to-the-minute market reality. It reflects a historical relationship between you and the landlord.
But if I move out today, whatever price the landlord lists that empty apartment for on the open market, and whatever price a new tenant is actually willing to sign a lease for today, that is the new tenant rent. That tells you the exact temperature of housing demand at this very second.
It is the ultimate clearing price of the market. And the data they cite points out that new tenant rents plummeted in the late part of 2024. This is crucial because new tenant rents are what economists call a leading indicator. They lead all other rents, which in turn led overall housing valuations.
So if new tenant rents are plummeting, it tells us that the sudden surge in demand has evaporated. But simultaneously, all those massive multifamily apartment complexes that developers started building 3 years ago during the boom phase, they are finally finishing construction and coming online.
So you have a sudden spike in available supply slamming directly into evaporating demand.
Which leads to the massive affordability crisis they highlight. The material states that homes are currently roughly 30% unaffordable relative to median incomes. We have a situation where the available single-family home inventory is largely locked up by older generations, the baby boomers, who either own their homes outright or are sitting on those 3% mortgages and simply refuse to sell.
They're golden handcuffs.
Exactly. Meanwhile, millennials and Gen Z buyers simply cannot mathematically afford to enter the market at current price-to-income ratios combined with 7% mortgage rates.
And they note a staggering statistic that perfectly encapsulates this entire gridlock.
Yeah.
It is now nationally significantly cheaper to rent a house than it is to carry a mortgage to buy that exact same house.
Wow.
And when the math tilts that heavily toward renting, the financial incentive to purchase a home collapses. That dynamic pulls the floor out from under home prices. A broad correction becomes not just a possibility, but a mathematical inevitability.
And they add a chilling piece of historical context to the timing of this inevitable correction, the 18-year real estate cycle. The analysis points out that we're currently exactly 18 years out from the onset of the Great Financial Crisis in 2008. If you look back through economic history, real estate tends to operate on these long, remarkably consistent cycles of boom, overextension, and bust, often clocking in right around that 18-year mark. You can trace it back through the savings and loan crisis in the late 80s and early 90s, all the way back to the 70s. We are hitting that historical 18-year anniversary right as the affordability math breaks and new tenant rents crater.
So to summarize the domestic situation for a moment,
Yeah.
the U.S. economy is balancing an AI equity bubble that is being threatened by a freezing private credit market, while the foundational real estate market is slowly rolling over into a major cyclical correction.
It sounds incredibly fragile.
It is. But the conversation then pivots to make a truly terrifying comparison. As fragile as the U.S. looks, another global superpower is already far past the rolling over stage. They are deep into the acute terminal phase of both a real estate and a demographic collapse.
And that brings us to China. The statistics provided regarding China's economy are genuinely hard to wrap your head around.
They really are.
They note that China's real estate crisis isn't a new development. It actually began in earnest back in 2021 with the collapse of major developers like Evergrande. And the sheer scale of the overbuilding is almost incomprehensible from a Western perspective. The material states that China is currently sitting on an estimated 30 years of excess real estate inventory.
30 years.
30 years. I mean, we've all seen the drone footage of the famous ghost cities. Entire, sprawling metropolitan areas complete with high-rises, 6-lane highways, civic centers, but with absolutely zero people living in them.
And to understand how a nation ends up with 30 years of empty apartments, you have to look at the intersection of central economic planning and demographic reality. The analysis traces this all the way back to 2008.
Okay, what happened in 2008 for them?
During the Great Financial Crisis, while the U.S. and Europe were experiencing severe deleveraging and bank failures, China essentially acted as the engine that bailed out global growth.
How did they do that?
They did this by embarking on the most massive, debt-fueled infrastructure and real estate building spree in human history.
They just poured concrete relentlessly for a decade to ensure their GDP numbers kept hitting the central party's target.
Exactly. Local governments were incentivized to sell land to developers. Developers were given endless cheap credit by state-owned banks, and average citizens bought multiple unfinished apartments as speculative investments because their stock market was too volatile to trust. But they built blindly. They built based on highly aggressive growth projections, completely ignoring the demographic time bomb that was ticking right in front of them.
And that demographic time bomb is what they identify as the true root cause of China's current economic black hole. It goes back to the one-child policy, which was implemented in the late 1970s and lasted for decades. I mean, you can't artificially suppress birth rates for a generation without eventually paying a massive economic price.
You really can't.
The data shows that China's total population demographically peaked in 2020. But the projection going forward is what's truly catastrophic. They are slated to lose 150 million people of prime working age as that massive older cohort passes out of the workforce and into retirement.
We really need to pause and absorb that number for a second. 150 million people.
Wait,
That is roughly the equivalent of the entire labor force of the United States, simply vanishing from the productive, wealth-generating years of the Chinese economy over the coming years. In macroeconomics, demographics truly are destiny.
I was trying to come up with a way to visualize this mismatch between their infrastructure and their population. Imagine you are a city planner in a booming town, right?
Okay.
For 30 years, you've been building massive shopping malls, sprawling apartment complexes, huge office parks. Every financial projection you make is based on the assumption that foot traffic and population will grow by 5% every single year, forever. You take on massive debt to build the ultimate mega mall. But the day you cut the ribbon on that mall, You look around and realize the entire town has aged into their 70s, they are retiring, packing up their cars, and moving to Florida. Who is going to shop at the boutique clothing stores? Who is going to rent the Class A office space?
Absolutely no one. And that is the exact crisis China is facing on a national scale. A rapidly aging retired population has a completely different economic profile than a prime-age working population.
Right.
Retirees don't buy new starter homes. They don't buy as many cars. They buy fewer clothes. They consume less overall, shifting their spending primarily toward healthcare. By demographically losing their prime-age workers, China is simultaneously losing its prime-age spenders.
And the macroeconomic fallout from this demographic shift is already highly visible in the data, according to the conversation. Since 2020, China's GDP growth, when you price it in US dollars to account for currency fluctuations, has essentially been flatlined at zero.
Zero growth.
Yeah. Before this demographic cliff hit, China's economy had grown to be 80% the size of the US GDP, leading to endless predictions that they would soon be the dominant global economic power. But since 2020, they have actually shrunk relative to the US, falling back down to just 60% of the US GDP size.
And even their own official state-released GDP numbers, which many economists believe are heavily manipulated to look better than reality, recently came in at just 4.3%. which the material notes is the worst official print since the depths of 2022.
So if you are the central planners in Beijing and your domestic real estate market, which accounted for nearly a third of your entire economy, has collapsed, and your domestic population is aging rapidly and has stopped consuming, what do you do to survive?
You return to the only playbook you have left.
Which is?
You try to export your way out of the crisis.
Right. And this is where China's massive internal demographic problem metastasizes into a global economic contagion. The analysis highlights how China has vastly increased its manufacturing output of certain goods like electric vehicles, solar panels, steel, and is aggressively exporting them, essentially dumping deflationary, cheap manufactured products onto the world market at prices heavily subsidized by the state.
They are desperate to sell these goods abroad to keep their factories running and their workers employed because they simply cannot sell them at home. And this aggressive dumping is exactly what is sparking the wave of global trade wars and tariffs we are seeing right now, not just from the US, but from Europe as well.
But the contagion isn't just hitting the West. The conversation points out the immense drag this situation has on the rest of Asia.
Look at China's closest neighbors. Japan is China's biggest trading partner when you combine imports and exports. South Korea's industrial economy is massively intertwined with China's supply chains. And the tragic irony is that both Japan and South Korea are suffering from their own equally severe demographic crises.
Right, they both have rapidly aging populations, shrinking workforces, plummeting birth rates.
We have this massive Asian economic bloc, which was supposed to be the undisputed growth engine of the 21st century, dragging each other down in a deflationary spiral, entirely incapable of generating internal, consumption-driven growth.
There's a fascinating structural point made in the material about Chinese society explaining why they can't just, flip a policy switch and transition from an export-driven economy to a US-style consumer economy. It comes down to the complete lack of a robust social safety net.
What's fascinating here is how critical this psychological and economic barrier actually is. In the West, despite all its recognized flaws and funding issues, there is a baseline societal expectation of programs like Social Security, Medicare, and unemployment insurance. If you lose your job or get old, you expect you won't completely starve in the street.
Right.
In China, that comprehensive state-sponsored safety net largely does not exist for the average rural or working-class citizen.
So, if you are a Chinese worker in your 40s and you are watching the economy slow down, you are terrified. You know that you are solely responsible for funding your own healthcare emergencies, your own retirement, and likely the care of your aging parents, due to the one-child policy leaving you with no siblings to share the burden.
Therefore, you are forced to save aggressively. You hoard every single bit of cash you can.
And when an entire population hoards cash out of sheer fear, it completely kills what economists call the velocity of money. Let's explain that concept for the listener because it's vital. Velocity of money is basically how fast a single dollar moves through the economy in a given time frame, right?
That's a perfect definition.
So if I go out and buy a coffee for $5, the barista uses her tip to buy a sandwich next door, and the deli owner uses that money to pay his local graphic designer. That one $5 bill generated $15 of economic activity in a single day. That's high velocity.
But in China right now, the velocity of money is collapsing. The worker earns $5 and immediately buries it in a savings account or buys gold out of fear for the future. The money just sits dormant. The analysis is very clear on this conclusion. Until the Chinese government fundamentally restructures its society to provide a real social safety net, which is incredibly expensive and difficult to do while debt is already so high, they cannot transition to a consumption-based economy.
So they are stuck.
They will remain an economic information black hole, consistently dragging down global growth and exporting deflation for the next decade.
We've spent a lot of time analyzing the failure of the working class to thrive in China. But before we get too comfortable, the conversation aggressively pivots the lens back onto the United States. And they do it by dropping what might be the most genuinely shocking single data point in the entire transcript.
I know exactly the statistic you're referring to, and it is a truly jarring pivot.
When I first read this part of the analysis, I actually had to stop, reread the sentence, and check the math in my head to make sure I wasn't dropping a decimal place somewhere.
It's unbelievable.
They introduce a statistic regarding current wealth inequality in the United States.
Right.
The richest, 0.00001% of Americans now hold wealth equal to 12% of the entire U.S. national income.
We really need to contextualize 0.0000001% for you listening. We're not talking about the top 1% or even the top 0.1%. We are talking about a microscopic sliver of society.
Yeah.
We are talking about just a few dozen specific households holding an incomprehensible percentage of the nation's total economic output.
It is staggering. I mean, the material explicitly points out that this specific level of wealth concentration tops even the historical peak of the robber baron era in the late 1900s. We're talking about the era of John D. Rockefeller, Andrew Carnegie, Cornelius Vanderbilt, a time in American history defined by absolute unregulated monopolies, immense opulent wealth for a handful of industrialists, and massive grinding poverty for the working class. To realize that our current wealth concentration mathematically exceeds that era, it completely shatters the mainstream narrative we often hear from financial media.
It does, because financial media frequently discusses the current economy as a K-shaped recovery.
Let's visualize that K-shape for a second. The idea is that if you trace the letter K, the vertical line represents the crash of 2020. Then the economy splits. The top arm of the K slants upward, representing the upper middle class, the knowledge workers, the people who own stocks and real estate who saw their net worth explode post-pandemic, and the bottom arm of the K slants downward, representing the working class, the service industry, the hourly wage earners who are being crushed by inflation and housing costs.
Right. The K-shape implies a broad division between two large classes of people.
Yeah.
But the data point presented here, the 0.0000001%, only 12%, suggests K-shape is a mild understatement. This isn't a K. This is a visual where a microscopic needle points straight up to the stratosphere for 50 people, and the line essentially flatlines for the remaining 330 million people.
And the conversation spends significant time analyzing the profound societal and political implications of this specific mathematical reality. Because when wealth inequality reaches robber baron levels, it ceases to be just an abstract economic issue debated in university seminars. It becomes a deep structural systemic risk to the stability of the society itself.
The analysis points out that this massive disparity is causing the younger generations, specifically millennials and Generation Z, to reach a psychological breaking point.
Understandably so.
They're becoming deeply and perhaps irreversibly dissatisfied with the traditional political and economic systems of the United States. They look at both major political parties, and they don't see a functioning democratic republic or a fair free market capitalist system. They view the system as a kleptocracy, literally, rule by thieves, or a gerontocracy, ruled by the elderly who have entrenched themselves in power and are hoarding all the real estate and financial wealth.
I mean, you can't really blame them for looking at the math and concluding that traditional American capitalism simply no longer functions for their benefit.
Yeah.
If you were 25, working a professional job, carrying $50,000 in student debt, and the median home price in your city is 7 times your annual salary, the American dream doesn't just feel delayed, it feels mathematically impossible.
And this raises a critical question, and it's a risk the conversation highlights with genuine historical concern. The risk of a hard pivot toward central planning.
Central planning.
Right. When an entire generation feels entirely locked out of the economic benefits of capitalism, they don't just accept poverty, they naturally begin to embrace radical alternatives. Specifically, the material warns of a growing embrace of socialism or heavy state-directed central planning among the youth.
The argument is that if this immense economic dissatisfaction leads the country down that specific political path, the ultimate result wouldn't be a fairer distribution of wealth, but rather massive wealth confiscation, capital flight, and a severe collapse of the economic dynamism that built the country in the first place.
And the analyst in the conversation draws a direct, really grim historical comparison to Soviet-era Russia to illustrate the endpoint of this path. They describe a centrally planned system characterized not by equality of prosperity, but by equality of misery.
Right.
A system defined by perpetual supply shortages, where citizens wait in lines for basic goods like toilet paper and groceries, while a new elite class of political party members and bureaucrats lives like kings in special dachas, and everyone else functions as modern-day serfs.
The argument is essentially that central planning doesn't eliminate inequality, it just changes the mechanism of it. It replaces billionaire industrialists with government bureaucrats, while simultaneously killing the innovation and productivity of the broader economy.
But the conversation takes this fear of a potential centrally planned future and synthesizes it with a harsh critique of our current quasi-capitalist present. If the middle-class real economy has essentially been dead or flatlining for a while, as the wealth concentration data suggests,
How did the United States completely avoid the severe recession that almost every major bank and economist predicted for 2023 and 2024?
exactly, this is where all the macroeconomic dots start connecting in a really uncomfortable way.
The analysis alleges that the only reason the U.S. avoided a technical recession, 2 consecutive quarters of negative GDP growth, was through massive, unprecedented, debt-fueled government deficit spending.
And they point to a specific, controversial example of this spending. They cite an estimated $1.5 trillion spent federally and locally on supporting the massive influx of migrants we discussed earlier.
Migrant support.
Right, funding emergency shelter, hotels, food infrastructure, clothing, and EBT cards.
Again, setting the intense politics of this entirely aside, let's just look at the mechanics of how that money moves. How does government spending on an EB2 card for a migrant actually mask a recession in the broader GDP data?
Well, GDP measures the total monetary value of all goods and services produced within a country. When the government borrows billions of dollars and distributes it, whether through EBT cards, paying hotel owners for emergency shelters, or hiring thousands of administrative workers, that money immediately enters the economy.
Right.
The hotel owner gets paid by the city, so the hotel owner goes out and buys a new truck. The grocery store receives the EBT funds and orders more inventory from the farm.
It acts as a massive, synthetic, debt-fueled stimulus package.
Exactly. It pumps raw liquidity into the economy, which keeps the aggregate GDP numbers positive on paper. But it's an illusion of prosperity. The actual underlying standard of living for the average middle-class citizen continues to erode because that deficit spending contributes to the inflation that makes their groceries and housing more expensive.
It creates a macroeconomic mirage. The underlying real economy is struggling with crushing unaffordability and high interest rates. But the headline GDP numbers flashed on the news look totally fine because the government is running multi-trillion-dollar deficits during a period of supposed economic expansion, which is historically unprecedented.
It's unheard of.
And what further masks this reality for the average person checking their retirement account? The stock market.
Precisely. As long as the S&P 500, which as we discussed earlier is currently heavily driven by that narrow, fragile AI bubble and the momentum factor, is sitting near all-time highs, the broader public narrative remains that the economy is strong.
But the entire analysis implies that this strength is a very precarious, hollow illusion. So let's step back and look at the big picture of what this all means. We have a deeply divided nation, staggering wealth inequality that rivals the 19th century, a younger generation thoroughly disillusioned with the fundamental economic system, and an economy running largely on the fumes of massive government debt, and an AI stock rally built on illiquid private credit.
That's a lot.
How can a nation in this highly specific, fragile condition possibly project strength on the global stage? Especially when projecting strength in the 21st century might require actual, physical, industrial manufacturing power, not just software algorithms.
That question is the perfect pivot back to exactly where we started this entire deep dive. The grand chessboard of global geopolitics.
Bringing it full circle.
The conversation takes all of these internal domestic vulnerabilities we've discussed and overlays them directly onto the kinetic conflicts happening right now in the Middle East, as well as the ongoing war in Eastern Europe. And they offer a very cohesive grand strategy theory for why these specific conflicts are unfolding the way they are right now.
Right. The transcript suggests that we are making a massive mistake if we view the missile strikes in Iran, the geopolitical tensions disrupting shipping around the Panama Canal, or the political maneuvering in Venezuela in isolation.
They are all connected.
The analysis theorizes that all of this is actually part of a massive proxy chess match, a coordinated global strategy aimed at one ultimate overarching goal: thwarting the rise of China.
It's a concept in international relations and political science frequently referred to as the Thucydides trap.
Let's explain that term for you listening, because it really frames the entire global dynamic. It comes from the ancient Greek historian Thucydides, who wrote about the Peloponnesian War, right?
Yes, Thucydides observed that when a rapidly rising power, in his time, Athens, in our time, China threatens to displace an existing established ruling power, Sparta then, the United States today, the resulting structural stress makes severe conflict almost inevitable.
Mm-hmm.
Historically, over the last 500 years, this dynamic almost always results in war, either directly between the two powers or through a series of proxy conflicts, as the ruling power desperately tries to maintain its hegemony and secure crucial global economic choke points.
Choke points like the Strait of Hormuz in the Middle East for global energy flow, or the Strait of Malacca in Asia for global shipping. But the conversation breaks down exactly why executing this proxy war strategy of containment is so incredibly dangerous for the United States at this specific moment in history. And it comes back to that physical industrial power I mentioned. The core argument made here is that the U.S. currently, fundamentally, lacks the manufacturing capacity it had during the mid-20th century.
They are pointing out that the legendary arsenal of democracy, the immense industrial base that allowed the U.S. to outproduce its enemies during World War II, is largely gone.
It's just vanished.
It was systematically dismantled and outsourced over the last 40 years in pursuit of cheaper labor, higher corporate profit margins, and lower consumer prices. We transitioned from an economy that built physical things to an economy based on financial services, software, and consumption.
So we find ourselves in a situation where we want to project power, but we don't necessarily have the factories, the raw material processing facilities, or the highly skilled blue-collar manufacturing workforce at the massive scale required to support a sustained, high-intensity global conflict. Or, frankly, even just to rapidly rebuild our depleted military stockpiles.
Exactly. We design the world's most advanced microchips, but we rely on highly vulnerable supply chains in Asia to actually physically manufacture them.
So if policymakers are recognizing this massive vulnerability, and we are clearly entering a new era of deglobalization where countries are realizing they need to pull critical supply chains back home out of sheer national security concerns, why is it so difficult?
What do you mean?
I mean, can't we just hit the rewind button? Can't the government just pass a series of laws, allocate a few $1 trillion, and build our own factories again? Why can't we just aggressively reindustrialize?
The reality check the analysis provides on that specific hope is quite bleak. You cannot simply flip a legislative switch and recreate heavy industry overnight. The conversation points out that it takes years and often decades to rebuild a true integrated military-industrial complex and manufacturing base.
Why does it take so long? If the money is there, what's the bottleneck?
It's a combination of factors. First, environmental and zoning permitting in the West can take years before a single shovel of dirt is even moved. Second, you have to rebuild the entire underlying supply chain.
Right, it's not just one building.
Exactly. A factory that builds missiles needs a domestic factory that processes the specific aerospace-grade metals, which needs a domestic mine. It's a web. And perhaps most importantly, there is a massive skills gap.
The workforce.
You can't just hire a software engineer to run a highly complex CNC machining floor. Building that workforce takes generational training. While there have been loud political promises and massive government subsidies announced to bring manufacturing back to the U.S., the reality on the ground is stalling.
It's the difference between announcing a grand policy at a press conference and actually pouring millions of tons of concrete.
Right. The analysis notes that complex trade and manufacturing alliances with allies like Europe and Japan are currently bogged down in endless parliamentary debates. And much of the promised federal money for domestic manufacturing facilities hasn't even resulted in a foundation being poured yet.
And speaking of our global allies, the conversation throws in a very quick but absolutely devastating detail about Europe's role in this global economic realignment. Europe is flatly described in the transcript as a demographic basket case.
They're pointing out that Europe is suffering from the exact same terminal aging population crisis as China, and in some countries like Italy and Germany, the demographic decline is even more acute. But unlike China, Europe doesn't have a centralized authoritarian command economy capable of temporarily masking the economic rot through sheer forced infrastructure spending.
And the really perverse, dark observation the analysis makes is about Europe's current economic state. They argue that Europe is currently going through a severe structural deflationary period due to this aging population, and the only thing providing any temporary economic reflation, the only thing generating raw credit creation, industrial activity, and employment in certain sectors is the actual physical war happening in Ukraine.
We really need to let that sink in for a minute. The economic argument being presented is that a massive kinetic land war has essentially become a necessary macroeconomic stimulus program for a demographically dying continent.
Wow.
The production of artillery shells and military aid is actively propping up industrial numbers that would otherwise be collapsing.
If we pull all these disparate threads together, the grand synthesis this conversation presents is a picture of a global economic system operating at absolute maximum tension with zero slack left in the line. The United States is attempting to use complex geopolitical proxy conflicts to contain a rising China. But China is internally collapsing under the weight of an unprecedented demographic and real estate crisis, threatening to drag the entire Asian bloc and the global economy down with it by exporting deflation.
And Europe is a demographic mirror image of China, heavily reliant on the horrific stimulus of a land war just to generate basic industrial economic activity.
And the U.S. domestic economy, which is theoretically supposed to be the stable anchor of this entire global system, is teetering on a precarious housing correction, propping up an AI stock bubble dependent on freezing illiquid private credit, all while running massive deficit spending to mask a recession and facing societal wealth inequality unseen since the days of the robber barons.
It is a breathtakingly complex, incredibly fragile house of cards.
It really is. We started this deep dive looking at a single theoretical military strike on a desalination plant or an airport in the Middle East. And by methodically tracing the arguments in our source material, we've seen how the economic shockwaves from that single localized event would travel through the price of a barrel of oil, cause massive demand destruction, crash into a highly leveraged U.S. consumer, pop an AI stock bubble, accelerate a housing affordability crisis, and expose the underlying fragility of a global economy caught between the demographic collapse of the East and the hollowed-out industrial base of a deeply unequal America.
And that interconnectedness is exactly why understanding these underlying macroeconomic levers is so vital. We live in a world of constant, deafening information overload.
Yeah.
The daily news cycle is explicitly designed to provoke emotional, panic reactions to isolated, out-of-context events.
Noise.
But when you take the time to understand the actual mechanics, when you see how private credit gating directly links to technology stock valuations, or how new tenant rents accurately predict housing affordability trends, or how the math of an aging population fundamentally dictates the destiny of superpowers, you gain the ability to see past the sensational headlines.
You stop reacting to the noise, and you start seeing the underlying structural architecture. You can prepare yourself and your business for the broader tectonic shifts happening in the real economy. We want to genuinely thank you for sticking with us through this incredibly intense, dense journey today.
It's heavy material, for sure.
But as we've seen, the cost of not understanding how these gears interlock is simply too high. We always like to leave you with a final thought to chew on, something that builds on everything we've discussed today, but pushes the horizon just a little bit further out.
So the analysis we reviewed today paints a picture where speculative financial bubbles are treated as an inherent, almost unavoidable feature of Western financialized capitalism, while demographic collapse is exposed as the fatal, unavoidable flaw of Eastern central planning.
So here's the question to ponder. What happens when a highly leveraged, financially unequal Western world finally accepts that it must physically rebuild its entire industrial manufacturing supply chain, but it has to accomplish this massive feat without relying on the cheap labor and the deflationary exports of the East? When deglobalization transitions from a political talking point into a forced physical reality, who actually pays the financial price for that incredibly expensive, highly inflationary transition?
This question we're all going to have to answer soon.
Keep questioning the consensus. Keep looking for the structural mechanics behind the daily noise. We'll be back to explore the next piece of the puzzle soon. Until then, thanks for joining us on The Deep Dive.